Hello and welcome to Portfolio Matters Weekly Update, Week 45. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Over to you, Keith.
Thank you, Richard. Well, after the success of our first pub night, we're going to do it again, and hopefully we're going to do it fairly regularly. So the next one will be on Wednesday, the 1st of December, and once again at the Princess Louise in High Holborn. And we hope to see everyone there. Richard gone.
I was just going to say, Keith, we will recognize you and you will recognize us because we will all be wearing flat caps.
Yes. Okay, news during the week. Well, the stock market and travel companies were boosted earlier in the week when Pfizer announced that its new drug Paxlovid cuts COVID hospitalization rates and death rates by 89%. So once that gets approval, hopefully we should see the end to this crisis, because even if you get COVID, it shouldn't kill you. Now, the Biden administration passed its $1.2 trillion infrastructure bill and is now moving on to its $1.75 trillion Social Security bill. And bond yields amazingly fell this week as Biden interviewed the dovish Lael Brainard as a possible successor or replacement for Jerome Powell. Now, I found this really interesting because it implies that bonds are being priced as the sum of the interest rates over the period rather than looking at real yields and inflation. Essentially, bondholders are ignoring inflation. Amazing.
They believe the Fed's mantra that it's transitory, presumably, Keith. Although they should be looking at their inflation-adjusted P&L accounts at this point, wondering what's gone wrong in the year.
Well, it's the fact they're buying, bonds at yield of for 1 year, 0.5% or something. And we've just seen that the US CPI's come out at 6.2. Absolutely enormous loss. It's amazing. So, economic data this week. US unemployment rate continued to fall in October, down to 4.6%, which was down on September and below expectations, which is great. Non-farm payrolls beat expectations, all good news. And in particular, private non-farm payrolls were strong, massively beating expectations because the US government has been shedding jobs. And so looking at the combined figure is slightly misleading in that private non-farm payrolls have been really quite strong. And as a result, average earnings are ticking up to 4.9% per annum, and that is inflation. If wages are rising at 4.9%, you're going to expect inflation to be at least 4.9%. And the Fed's got a target of 2% and is talking down inflation as transitory. A participation rate remained stubbornly low at 61.6% and was below expectations. And the big news of the week was US inflation, which once again came in hot. CPI came in at 6.2%. There's a big jump on September and beat expectations. And core inflation also ticked up to 4.6%. Again, much higher than September and well above expectations.
It's interesting, Keith, isn't it? As we talked about last week, that expectations basically is a trailing indicator. And it indicates that all the expectation is it's taking last month's figure and possibly adding a bit to it. There doesn't appear to be any predictive value in the expectations at all.
Yeah, well, it's the work of economists, Richard. So, the value of economists is open to question. As a result, US 1 year ahead inflation expectations continue to rise, and they have hit 5.7%, well up on September and well ahead of expectations. And that really matters, because if workers are expecting higher inflation, they're going to demand higher wages, and you get a price wage spiral. Now, moving on to the EU, the ZEW Economic Sentiment Index ticked up in October to 25.9, up from September and well ahead of expectations. And that's very good news, because that means that despite all the recurrence of COVID in Europe and the supply chain disruptions and rising energy prices, actually European businesses are feeling more optimistic about the future. And the same was true in Germany, which again showed a strong rise in the economic sentiment index. In China, inflation was 1.5% year on year, which was a big rise on September and above expectations, but still, if we believe them, quite subdued. And Chinese producer price inflation was very strong, 13.5%, up from 10.7% in September and above expectations. And we'll show you a graph in a minute. Now, the UK GDP growth year on year fell to 5.3% in September, down from 6.6% in August. And UK manufacturing continues to decline steadily back to its historic norms. So it was only 2.8% in September, down from 4.2% in August, and missing expectations. Construction production rose 7.2% in September, which is a strong number, and it beat expectations. We also had a couple of quarterly numbers, and these are subject to base effect issues. So Q3 GDP growth was 6.6%, down from 23.6% in Q2, slightly beating expectations. Now, the big number was quarter-on-quarter GDP growth, and in Q3, that was only 1.3%, which was below expectations. Some charts which we'll push through. The US unemployment rate continued to fall steadily, and that's great. Non-farm payrolls this year have been strong and picked up. Private non-farm payrolls were even stronger. Now, 1 year US inflation expectations are on a steadily rising path. And if I was the Fed, that would be a concern. The EU economic sentiment ticked up and stopped falling. Same with Germany. US inflation has hit the highest levels seen since the late 70s, early 80s. And that's the core. Initial jobless claims in the US continue to fall. That's great. And continuing jobless claims are also falling, though they ticked up last week, all of which paints a picture of a strong US economy. UK manufacturing production, sadly, is returning to its historically low levels. But construction production, although declining, is strong. And on to inflation watch. Okay, so this week we had revised numbers for the US, and they were strong. 6.2% CPI, 4.6% core CPI. And you remember that the US Fed will start tapering from next month. But bottom line is, they're still pumping a lot of money into this economy.
Yeah. Well, it's they're pumping in. It's still 120 at the moment, and as you say, it's tapering. I think over the course of the next 8 months, there will be a current projection an additional 500 billion pumped into the economy. Interest rate of 0. and inflation of 6%, very roughly speaking.
Yep. So this is global inflation, which continues to rise. And Nordea are forecasting that EU wage growth is going to pick up strongly in the current year.
I read in today's FT that Cargill workers are planning to go on strike, which said will cripple the world's largest commodities trader. Again, I would say that this concept that because the trade unions are far less strong than they were in the 1970s, we can't have a wage price spiral, I think is false. I think people feel strongly they're not being paid a fair share of corporate profits, then collectively they will act, and I can see that's happening. I also think there's probably growing resentment against the super rich people flying around the world in their aeroplanes when everyone else has to have two parents working in order to feed the family.
Yeah, flying around the world in their airplanes, lecturing us about climate change.
Yeah.
EU wages will reach 3.2% next year, and that is a wage price spiral in action.
I also think, Keith, that the EU wage increases will reach 3%. Well, it's like, well, of course they will. Why have they been so low over the past few years? Because well, we know why, because workers have been taking, and I think we have a chart later on, workers have been taking a smaller and smaller proportion of corporate profits. And I think this is about to change. And there's a lot of scope for it to change.
Yes.
And one of the reasons we have these shortages is because China seems to be repositioning itself as no longer the supplier of the world's cheap goods. And as it takes itself out of that process, it focuses more on its internal economy. The production of those cheap goods is going to have to move to higher cost nations, and that is going to feed through into inflation. So it's like we are now experiencing. So the supply shortages won't really change until reshoring occurs, and we're now experiencing the opposite of the disinflationary cycle of cheap labor.
Yes.
And I see this as continuing for a number of years.
Well, we've got some great charts on that point. We'll discuss it further in a second, actually, Richard.
Yeah.
Now, this is a really interesting chart, and this shows the effect of the US vaccine mandates. Now, the federal government has mandated that all public employees need to be vaccinated. And as a result, federal employment has fallen because some people refuse to get vaccinated and have been fired, essentially, or left the job. And you can see that effect on the non-farm payrolls we discussed earlier. Now, from the 4th of January next year, all employees in companies with more than 100 employees will have to have vaccinations, or they will have to take weekly COVID tests. And if you see the same effect in private companies that you've seen in government jobs, then you expect people to leave work rather than have a vaccination, and that will exacerbate labor shortages, which will have knock-on effects on wages, basically. Companies will have to bid up for a shrinking labor force. And on Richard's point, this is the inflation for goods coming out of Chinese factories, and it is rising quickly.
Which isn't surprising, given that we've got Chinese PPI, was it 13%, Keith?
Yeah, absolutely. Chinese companies passing prices on. And fertilizer prices are going through the roof. That is food inflation coming your way. And this is US producer price inflation, and companies will seek to pass on their input inflation. And in fact, the blue line is finished goods inflation, which is running at about 12.5%.
That's extraordinary, Keith. I mean, that is moving into what I would call a dangerously high level of inflation, where you will start to get wage demands in the approaching 10%. And that really does engage a wage price spiral. And the difficulty there is the only solution that the central banks have is to raise interest rates.
Yeah.
And if they raise interest rates, they crash the economy. And they don't necessarily address the fundamental problem, which is a supply shortage. In fact, it may aggravate a supply shortage by putting companies out of business.
Yep. I agree with all that. I think you just talked yourself out of a job at the Fed, Richard.
But Keith, I thought I was on the list.
Send in your CV, they're hiring.
I thought that's what that phone call was about.
So as a result, underlying inflation is at its highest level since they started measuring it, basically. And a recap, we still expect US inflation to keep rising on the back of rising rents. Now, rents are 32.5% of the CPI basket, and so far they have not risen that much. They've only risen by about 3.5%, whereas ex-shelter has been much stronger, and you would expect rents to follow house prices, and house prices have risen by 20% this year, and so far rents have not risen by anywhere near that much, but they're catching up. And the rental component of CPI has been rising, and we can expect that to continue. But of course, one of the bigger reasons that we have such elevated inflation is freight costs. And this chart in the blue shows truck transportation costs are running at 17%, and warehouse construction costs have gone through the roof. But freight rates have started to come down. So the Baltic Dry Index, you're seeing a decent drop in the past couple of weeks. But we have very high inflation and we have very low interest rates. As a result, real interest rates are extraordinarily stimulative. So you have real interest rates in the US of -5%. And next year, they're still forecasting to be -3.6%. So you have very high inflation and really stimulative monetary policy. And they're still printing money and sticking it into the economy.
Going to end badly.
Yep.
Maybe it is ending badly.
Well,
to know.
More on that in a second. So real interest rates are at their lowest since the 60s. And cash is absolutely the worst asset to hold for anything other than a brief period of time, because it's systematically draining away between your fingers. And economists are raising their inflation expectations.
Well, they are, but I mean, goodness me, how behind the cow's tail is it possible to get and still call yourself something useful?
Yeah.
It's like, come on.
Yep. And but you'll notice the difference between economists' expectations for inflation and consumers. Yeah.
Well, consumers are real economic agents, whereas economists do use one or two dimensional mathematical models.
Yeah. And for now, wage growth in the US has not been particularly elevated.
I thought it was interesting. Last week I commented on the John Deere, who manufacture farming equipment, and the workers on strike there demanding very high, relative to previous recent history, high increases. And then the next week we have Cargill, which is also in the agricultural sector, demanding similarly significant wage increases. And the agricultural sector is hugely vulnerable to this because, of course, the economy can't live without production and distribution of food.
But also, all these workers are reading in the papers about how the companies have making record amounts of money. Profit margins are at an all-time high. So they want their cut quite reasonably.
Which is fair, absolutely, yeah. So I just think this is beginning, not ending.
Yeah, I agree with that, because essentially wage growth is not keeping up with inflation. And so people's living standards are actually declining. And you'd expect them to do something about that, either resigning and get a higher paying job or going on strike for better wages.
Yeah.
And as a result, small businesses in the US are reporting that labor is their biggest problem. So they're going to be bidding up for workers, raising wages.
Mm.
And okay, bottom line, we have inflation because demand exceeds supply. So the top line shows demand for consumer goods. The red line shows production of consumer goods. Yeah. And so we've given consumers a load of cash in the form of COVID stimulus, and they're spent it on goods. And where we are now, the Biden administration has passed a 1.2 trillion fiscal stimulus package in the form of the infrastructure bill. And they're just trying to pass a further 1.75 trillion in the form of the social security. In the meantime, real interest rates are minus 5.5%. And anyone is surprised we've got inflation? It's extraordinary.
Yeah.
But on that note, this is the forecast path for inflation, and economists, Oxford Economics, are forecasting will come down. But of course, if we get a wage price spiral, it ain't going to come down.
And also, I mean, this is absolute certainty of forecasting. There's no error bars. There's no in this scenario, in that scenario. To all intents and purposes, it's gobbledygook, because it gives you nothing other than a line which anyone can draw. A 5-year-old child could draw the line. It's meaningless. It's frankly meaningless. Makes me angry.
How old are you again, Richard? What's that program on TV? Grumpy Old Men.
Therefore, I'll put my flat cap on. Batman and Robin is a nice cartoon, that.
Yeah. Okay, Richard.
Thanks, Dee. So I just thought we'd put a few graphs in about China Evergrande, which we've spoken of periodically over the last half dozen weeks or so. So this is a chart which shows the size of the Chinese property market as the largest asset class in the world, and much larger than much larger, almost twice the size of the US property market, which itself is enormous, but so large that it still hugely distorts the fixed income and equity asset classes in China. In the US, Japan, UK, and Australia, that distortion is not the same. So, there it is, and that sort of sets the seed for how important the Chinese property market is, not just to China, but to the world economy. And then China's high yield credit spread. So I know yesterday that the Chinese government announced that it would be relaxing some of the rules that have caused the Chinese property market such distress recently. I think because they don't want to initiate a total crash in the property market. But Chinese property market high yield credit spreads are showing extreme distress, and 26% interest rate, priced getting on towards being priced for complete bankruptcy, heading in that direction.
And of course, Chinese property developers have historically had to borrow a lot of money to fund their expansion, and they're not going to be able to do that, and that's going to hit construction growth.
Yeah. So, and this is the real estate owners and developers index, which has dropped substantially. It's only halved actually, but it's still a substantial drop over the course of say the last 8 months. Something interesting I also read is that Chinese local authorities are demanding that the deposits, prepayments made by purchasers of Chinese new development property, that those proceeds go into finishing, building out existing developments and are not applied to debt repayments. So the source of cash available to indebted property developers, which typically they would use to fund their debt, which is prepayments from purchases of the property, of the unit, is no longer available to them. And in a sense, it's teeming and lading by the property developers, and that ability is being removed from them, again, aggravating the debt crisis. As we've talked about from time to time, the Chinese credit impulse is continuing to turn negative, which means that Chinese GDP is going to continue to struggle. And we are undoubtedly going to see a significant slowdown in the Chinese economy. And Chinese developers basically are getting to the point where they can't sell bonds because nobody wants to buy them because there's so much uncertainty about whether they are actually viable businesses. But of course, they need to refinance their debt.
Yeah. Am I right in thinking that these Chinese property developers, the way they build is that the purchaser puts down a deposit, but then the developer actually needs to build the flats before he gets full payment from the purchaser, and therefore they have huge working capital issues. So they need to issue loads of bonds in order to fund their developments. And if they can't sell those bonds, then essentially they don't have enough working capital to build the flats.
I think that's right, Keith. Yeah, and they're assuming that, let's say they borrow $1 billion to build 3 high-rise blocks of flats. They will take some deposits, but until they've finished building them, the people can move in. The sale isn't completed, and at the point the sale is completed, the debt in theory can be repaid. But you also wonder, if their debt is so high, is it higher than the total quantity of being built and unbuilt property, or have they actually fundamentally been running at a cash loss for many years, and the cash simply isn't in their system to pay the debt? And I suspect it's the latter, and I suspect there has been some fairly cute accounting going on, which has transferred effectively debt into profit. Well, the profit has been taken.
Well, the very fact that they're having trouble paying the interest on their bonds, not the principal, the interest, suggests you're right.
So Chinese house sales are below average, and it's in fact quite a significant drop. It's sort of halved from 45 to 2022, and now it's ticking up a little bit. I think obviously it remains to be seen what happens over the course of the next few months, whether it stabilizes around this level or whether it sinks further. And I think the Chinese government is now running a little bit scared. And so Keith found this. So this is the other side of the coin. Goldman Sachs effectively saying that the Chinese government will not allow there to be a systemic crisis, and that these junk bonds are a good investment. So if they are correct, the Chinese government will blink. And I suspect it will have to blink, because I don't think it can afford to see its property sector crash. So this is a comment which I won't read it out, but it is from Rabobank, and it's highlighting the risk to the Chinese and the world economy of this huge debt pile in the Chinese residential property market.
10 largest developers carry debts of 1.7 trillion off book.
I mean, I think that's the issue. That's part of the problem. You don't know if it's going to be a systemic crisis if you don't know how deep the roots go into the economy.
Yeah. It reminds me of the Lehman crisis. And
Goldman are forecasting a slowdown in China's property sector will have a large impact on its economy, which it will do, because property is 30% of the Chinese economy. And what this is basically saying is the contribution of these different services in the different colors to GDP, and their negative contribution going forwards from this point as property development reduces hugely. So, it's basically saying that in a year's time, the Chinese GDP will have shrunk by 1.5%.
Okay, moving on to demographics. And I saw this tweet from Albert Edwards, who is a perma bear on Twitter. This is a favorite argument of the bears, which shows that there is a strong link between an aging population and declining inflation. Basically, as the population ages, old people don't spend much money, and they certainly don't borrow and invest in new projects. So you expect the velocity of money to continually decline and inflation to fall with it. And here you see a correlation between the dependency ratio in the US, which is in black, and CPI inflation. And you can forecast the dependency ratio very well. So if this relationship were to hold, then you'd expect CPI inflation to keep falling to basically zero by 2030 odd. There's also a strong link between declining demographics and declining GDP growth. If you think of the GDP formula, it is dependent on labor, i.e. hours worked, and capital and productivity. And if you have fewer workers, then the amount of labor that is put into the economy will fall, and so will GDP growth. So here, you're forecasting on demographic trends that the US and the UK will fall to, what's that? 1% GDP growth in line with Japan by 2030. Now, I'm going to push back on this. I think there is a link, but the Weimar hyperinflation was not caused by a very high birth rate. This is a single factor model. And if you print enough money and do enough fiscal, you can get inflation as high as you want, as the US is currently demonstrating.
We have a problem, don't we, Keith, in that correlation looks very pleasant, but all economic systems are vulnerable to discontinuities. And I believe we are on the brink of seeing a major discontinuity. And if we see a discontinuity, then this correlation will simply fall apart. It may then re-correlate once the discontinuity has occurred. But if we get a wage price spiral, which is not anything to do with demographics, to do with other factors, then the correlation is spurious.
Agreed. Okay, now the other thing I wanted to talk about was there's a lot of talk about, is there a bubble in the Nasdaq? And you have seen the share price of Tesla and other technology stocks go through the roof. So this is the performance of the Nasdaq during the dot-com bubble, which lots of commentators are drawing a parallel with. And you will see that bubbles tend to end in a blow-off top, as essentially everyone sees everyone else making money by buying stocks in the Nasdaq, and they try and join in, and you see an acceleration in trend.
Yes, exactly, Keith. We have a trend here, and then an acceleration shooting up.
Yeah, and that is very clearly seen on the log chart. You see, so the orange line which I've drawn in is the trend, and then in the final 6 months to a year, you see a sharp acceleration. And because it's a log chart, it disguises the fact that in 6 months it went from below 5,000 to 7,500, so 50%. So is the same happening to the Nasdaq? And this is the long-term chart going back to 2010. Well, the answer is not really. It seems to me that the Nasdaq is on trend, is not accelerating. Although when you look at the US performance of the US stock market relative to the rest of the world, it has been absolutely extraordinary. So this is the S&P divided by the MSCI World excluding the US. And you see, since 1990, the US has outperformed by fivefold. And as a result, US valuations look incredibly stretched. Although, of course, bond yields are very negative. And
of course, the bond yield is the inverse of the equity market, isn't it? So the two go hand in hand.
Yeah. So it's the Tina trade. There is no alternative. And the valuation metric, Shiller's Cape, cyclically adjusted PE, continues to march higher towards its dot-com highs. And that can't last forever. It can't. The stock market can't be driven higher by multiple expansion indefinitely, and things that can't continue forever don't.
In fact, if you just sort of extrapolate that up to say 45, where it would beat the dot-com bubble, that would be around about a 10 or 15% increase would be possible as a blow-off top.
Yeah.
To get a blow-off top bigger than that, the Cape Shiller would have to be really significantly higher than the dot-com bubble.
Yeah. And also, you notice, Richard, you never reach, as Irving Fisher famously forecast for the 1929 bubble, a permanently high plateau. That never happens. What you get is a peak and then collapse. And in aggregate, the market capitalization of the US equity market is at a record multiple of GDP and massively higher than the dot-com bubble. Although, having said that, the Nasdaq is not in aggregate in a bubble, certain stocks within it are, have extraordinary performance and are going parabolic. So this is Nvidia, the chip maker. Although, stocks, bubblish stocks like Peloton, which essentially is the innovation of sticking an iPad onto an exercise bike, well, that's coming right back down to earth.
Yes, and I suspect it has got a little bit further to go yet, Keith.
Yeah. The George Soros boom-bust framework, and I'm not going to go through this line by line, but if you're interested, pause the video and have a read. But what I liked about his framework was 5 and 6. So point 5 is the moment of truth where it becomes clear that reality cannot match exaggerated expectations. Now, in the case of a company like Tesla, which share price has gone through the roof, I think, are we yet at that stage? It would seem that expectations continue to rise, frankly. But then stage 6, twilight, when people continue to speculate on the trend continuing, even when they no longer believe in the fundamentals. And that's where, I think we're approaching stages 5 and 6. Okay, so what do we think? Well, I lived through the dot-com bubble. Both of us lived through the dot-com bubble, and I don't think there's similar euphoria. During the dot-com bubble, everyone was talking about internet companies and their investments, and you just don't see that sort of euphoria at the moment.
So I remember during the dot-com bubble, Keith, Fifes, the banana importer, became an internet darling because they decided that they were going to put their banana or fruit distribution systems online, and the price of this banana importer went up 4 or 5-fold because they were going online. But basically, they're just importing bananas, and that's a metaphor for what was happening.
Well, yeah, you look at what's the electric vehicle maker? Is it Rivian?
Oh, yeah.
Listed this week and has got the same market cap as Toyota, despite it selling like 1,000 vehicles this year.
Yeah, it will all stabilize. It's just that. So that part of the market is a bubble.
Yeah, absolutely. So I don't think the wider Nasdaq is in a bubble, and although parts of it are, when they burst, how much of a wider systemic crisis will that cause? Well, when the dot-com bubble burst, actually, companies that had real earnings did perfectly well. So as long as the economy is strong, I don't really think it'd have that much of an effect. Okay, so moving on to other charts. Richard, do you want to take these?
Yeah, so this is a chart showing the global sustainable energy fund flows. And what it indicates is that there's actually fairly significant sustainable energy fund flows in Europe, very little in US and the rest of the world, which means Europe is the driver behind sustainable energy. And interestingly, that may mean that it comes out with a competitive advantage because it will have developed the technologies and the manufacturing capacity that the rest of the world won't have and the US won't have. Remains to be seen. But put your money where your mouth is. Europe is, and the US and the rest of the world isn't. And spending on goods and services remains elevated. Goods rather than services, big one, remains elevated. So services expenditure in the US hasn't recovered from the pre-pandemic levels. Services spending on goods has exceeded pre-pandemic levels significantly. Keith, what's this one telling us?
Well, I think this is a really interesting chart, and actually one of the most important we're going to show you this week. So what this chart shows is the percentage of export revenues that emerging markets spend on debt servicing. So emerging markets make all their foreign exchange earnings from exports, and how much of that are they spending servicing debt? And when that rises above 20%, you tend to see debt defaults. And it is rising. And if it carries on like this, emerging markets are going to suffer financial stress, and we can expect an emerging market debt crisis. Now, you'll have seen during the week, Argentina are fighting the IMF. And what is interesting is that a lot of emerging markets like Argentina actually have very good terms of trade at the moment because commodity prices are high. And despite that, they're struggling to service their external debts because of the extra debts taken on during the COVID crisis. So watch this space.
Yeah. So this chart shows that there's an awful lot of US dollars standing in reverse repo ready to buy. And the US is obviously going to have to issue a great deal more debt to cover Biden's spending plans, 1.5 or 1.7 trillion spending plans, plus funding the government anyway. And the money that banks currently have sitting in reverse repo should be available to buy these treasuries, assuming the banks consider the risk to be appropriate, which they probably will because they have their arms twisted by the Fed anyway, or who will manipulate the interest rate on the reverse repo account.
Yeah.
So there's a lot of cash in the system. And this chart is talks about what we were discussing earlier, which German real wages versus German labor productivity. So productivity has gone up 40% in the last 30 years, and real wages have gone up 8%. And there's this enormous gap between that shows that labor has not benefited from productivity increases. And my contention, our contention, is that this gap is going to close. But whether it closes entirely or whether it sort of closes to halfway, whatever happens, there's a significant degree of inflation, wage inflation, that is going to come out of the system over the course of the next year or two.
Yeah, what it shows is that workers have not participated in the increase in national wealth.
Why do we have a shortage of truckers, Keith? What's this chart telling us?
Well, it shows exactly the same as in Germany, that truckers, their real wages have fallen substantially over the course of the last 30 years. So if you go back to, actually it's more than that, it's 45 years. This chart starts in 1970, and it shows that since then, if you divide the truckers' wages by CPI, they've gone down by 30%. So truckers are 30% less well off than they were in 1970.
And most of that movement occurred in the 25 years after 1970, Keith, didn't it?
That's true. Yeah.
Which is interesting.
It's a job with working very long hours for relatively low pay. So
US home equity almost at 30 trillion. But if you cast your mind back to the chart of the residential property market as a percentage of GDP, the US is far lower than China, even though the actual value of the home equity is something like 1 times US GDP. Okay, so this talks about refers to the issue that we have with labor not participating in productivity and wealth increase. So Wall Street Bank made $7 billion, $7,000 million in fees from the rise and fall of GE since 2000. And that is extraordinary, that much money has been made from GE. And to me, it speaks of the fact that currency, the US dollar, and it's the same whether it's the pound or the euro, has become totally devalued in this financialized economy that we live in. I don't know what you think, Keith.
Well, I'm just wondering how much shareholders made. I mean, it just seems like total abrogation of responsibility, financial responsibility on the part of GE management.
Well, I suspect if you look at a chart of GE shares, you'll find that they haven't done very well. I don't know what the dividends were. So what the total return on GE has been over the last 20 years, I don't know, actually.
No, the share price has been terrible.
Yeah, I suspect the total return has been negative.
Yeah. Finally, on to COVID. So this is the UK. The blue line is this year and the white line is last year. And recently, we've seen a tick down in COVID cases, but we are going into the winter flu season when COVID type viruses tend to do very well. So frankly, it's too early to tell where we won't have a winter peak. Now, I thought this was interesting because everyone was saying, how badly Sweden had done because of its laissez-faire attitude to the virus. Well, they don't look so bad anymore, frankly. Seems to be done all right. That's herd immunity in action. But returning to the UK, actually, things look pretty good. If you look at the black line, that is the week-on-week change in the cases of COVID in the 80 plus range, who are people most likely to end up in hospital and end up dying from it. And as you can see, there's a steady decline, in part due to the UK policy of issuing vaccine booster shots. All of that is very encouraging.
So it's interesting, Keith. I was reading a Sky News article yesterday on this. They'd gone to the coronavirus ward of some UK hospital, and they talked to the consultants in charge of the ward, and they said, and the numbers have doubled since in the last 6 weeks or something of that nature. And they said, who is being admitted? And we said young unvaccinated people. Young unvaccinated. So the young are, if they catch it, are far less likely to have severe symptoms, but there's a lot of them catching it.
Yeah.
And the answer is get vaccinated.
Yep. Okay, on to the checklist. And we had an odd week in that the UK actually outperformed the rest of the world. So the FTSE was up 1.2%, very credible performance. Stocks Europe up 0.4%, S&P down 0.7%. Nasdaq down 1.5%. Topics was flat. Bitcoin up 3.7%. Richard will have something to say on that. And the UK's banana currency fell down 0.9% to 1.34. Now, I thought this is something I have got completely wrong this year. I expected that rising inflation would lead to rising real yields and the outperformance of stocks that did better in a rising yield environment. And actually, the opposite has happened. Stocks that have done well are the ones that are most correlated with falling bond yields. So long duration stocks, high-tech stocks.
Okay, I think what this chart is showing us is that the anti-contrarian investor is the one who is doing best.
Yeah. And as a result, the momentum trade is back. So buying stocks that have gone up has been a great strategy. And, Tesla being a great example. Just when you thought the valuation was absolutely absurd and couldn't get any worse, then it goes up 55% in a month.
It's extraordinary.
And this is something we touched on last week, but is the distribution of stock returns for S&P 500 constituents between 1995 and 2021. And it shows that there are a lot of stocks which create no value at all and go bust, and actually just a few who make extraordinary returns. And so hanging on to your winners is an absolutely essential strategy.
Thanks, Keith. So chart of ESA is actually, it's sticking in that nice trend channel that initiated at the beginning of October. It is down a little bit over the last couple of days, but it has reached a new all-time high about 5 or 6 days ago. So my view is that it will continue to go up towards the end of the year and possibly into January. I'm watching it very carefully. I don't want to give back any of the gains I've made on it. And Bitcoin is actually, in far less of a trading trend, rather, and it's more bouncing around. It's been at this level. It's sort of reached a new all-time high a few days ago, but it's been at this level now for the best part of a month, and it hasn't really gone anywhere. And I come back to this point that ESA actually has a real world use, whether you think it's sensible or not. It does. Bitcoin, its only use at the moment, I believe, is that it is considered to be a store of value and somewhere to put your money other than US dollar denominated debt.
Okay, on to the energy market, and it was generally a strong week. The oil ended up 1.1%. Dutch natural gas futures ended up 1.9%. Now, we have previously talked about how Gazprom were due to start increasing their gas exports to Europe in November, and we'll show you a chart in a moment. They have done, but it's been really quite pitiful. So gas prices have started rising again going into winter. And a reminder, they're up 291% this year. Coal continued to weaken. We are obviously having COP26 in Glasgow. And with a bit of luck, we might get an agreement to massively reduce world coal usage. A reminder, the Chinese are building loads of coal-fired power stations.
I don't think we will, Keith, because both China and US have said they won't commit to reduction in fossil fuel usage. So I don't think we will. And China, because it can't, well, it can't because it is so dependent on fossil fuels. And the US, I think, really, because it doesn't want to, for whatever reason, because I'm sure it could do.
Now, sadly, I agree with you, Richard, but if we're going to tackle the climate crisis, we need to stop burning. China was burning that 12 million tons of coal every day, as we discussed last week. Anyway, uranium is rising, and an obvious fix for the need to raise base level power production without using coal is nuclear power stations. So we're going to need more uranium. So this is crude oil, which had a volatile week, but ended slightly up. So this chart shows the cost of capital for various sources of energy. And as you can see, the ESG movement has massively cut the amount of capital available to oil and LNG and raised their cost of capital. Now, for an investor, it's the flip side. So if you invest in offshore oil, you're going to get 20 odd percent. Whereas if you invest in offshore wind and renewable energy, you're going to get 3 or 4. Invest where you feel comfortable would be my personal opinion. Now, this is the path of oil production, and OPEC continue to unwind their quota cuts. And so last month, production rose by 480,000 barrels a day, which was more than the 400,000 barrel a day increase that they mandated. But production is still 600,000 barrels a day below quota because of the failure of various countries such as Nigeria and Angola to meet production targets. And those countries are in long-term decline. And oil demand picked up strongly globally in October, led by India, which had record gasoline demand. But OPEC revised up their forecast for the deficit. But what I mean is they're previously forecasting that there would be an excess of demand over supply of 2.7 million barrels a day during Q3, and they've revised that to 2.2. So more supply, less demand. And they are forecasting that we will move into surplus in Q1 next year, which is obviously very bearish for the oil price. And I liked this. Doing your bit for climate change essentially involves quite a lot of virtue signaling currently.
I was listening to an interview of, I think it was the CEO of British Airways on Radio 4's this week. And the interviewer missed a seminal question. He's talking about green air transport, and the CEO said, we're going to be moving to green. And the interviewer didn't say, well, where are you going to get your green fuel from? Which, of course, is agricultural production.
Yeah,
which is
that's
not
true.
green.
But reminder, this is seasonality pattern for oil, and it is very strong declines right now in November and early December. Okay, moving on to Dutch natural gas futures, which having come off as there seemed to be the promise of an end of this crisis, as Gazprom indicated it would start refilling European storage, they've ticked up because we've now got some of the extra supply from Russia, and it ain't much. Essentially, gas imports from Russia increased, but are still below the 5-year minimum. And gas transit through Ukraine at 100 million cubic meters a day is well below its minimum over the previous 5 years of 140 at this time of year. And you will all be aware that Belarus are now threatening to cut off gas in transit to Europe as part of their dispute with the EU. Coal had a bad week. Uranium had a good week. And on to industrial commodities, which were mainly quiescent. So aluminium flat, cobalt continued to tick up, and a lot of the green tech transition elements had a good week. So cobalt up 1.7, copper up 0.7, chromium was flat. Iron ore continued to fall heavily to new lows, down 8% on the week. Lithium was flat at very high levels, up 318% on the year. Magnesium recovered a bit, up 5.8%. Neodymium, another green metal, up 7% on the week, up 210% on the year. Nickel, which is used in green batteries, up 3.3%, up only 20% on the year. Tin continues its extraordinary rise, up 3.2% on the week, and ferrovanadium fell in line with iron. Aluminium chart, cobalt, green metals ticking up strongly, copper in its range, but copper inventories continue to fall. That is very bullish, and electric vehicle demand is picking up. And electric vehicles use a lot more copper, and you need a lot more copper in the electric transmission system. Chromium continues its slightly mystifying bull run. Iron ore sinking as Chinese iron ore inventories rise because they have clamped down on steel production. So that is bearish for iron, frankly. Lithium, great run. So magnesium had an extraordinary spike on the back of the reduction in smelter output in China as a result of their attempts to cut down on power consumption. And then as those power shortages have eased, so magnesium supplies have more normalized, but they remain high compared to just 3 months ago. Neodymium ticking up. Nickel, that looks like a nice trend. Tin, this is a chart going back to 1970. Extraordinary. Ferrovanadium following iron down. Okay, on to precious metals. Richard.
Thanks, Keith. So gold, silver, platinum all had good weeks. Rhodium slightly up, and palladium pretty much unchanged. So if we go on to the charts, so gold has broken out of this wedge. Now, whether I don't know if you've been following sort of the punters, not the punters, the commentators, but they will be saying if gold breaks over 1830 or 35, then it has broken out of this wedge and it will move to the next point of resistance, which is around about 1960, 1970. And you can see where that 1830 comes from, and it's broken through that line. And the question in the mind of the commentators is it going to now proceed to move up to 1970? It's also in my mind as well, because I have quite a lot of gold mining shares. Clearly, it was moved by the inflation news from the US, which, as we've discussed, was very poor. And if we look at the chart of silver, which has basically been in this sort of range for a long time, since July last year. And although silver has moved up substantially over the course of the last month or so from 1900, I beg your pardon, 2150 to 2500, it's still got quite a long way to break out of that range, which is at around about 2800. So if silver breaks through 2800, it will then be on course possibly to move back up towards its all-time high of 50. Now, the next chart is a chart of the US dollar, and it is commonly believed that precious metals move in line with the dollar. And the last week, this is actually a weekly chart, so it's not too clear, but in the last week, the dollar index has risen strongly, as have gold and silver. So something has changed a little bit there, and clearly the market is getting concerned that inflation is not transitory, is sticky, and I think is likely to understand that inflation is very likely to go significantly higher before it stabilizes or falls.
Yeah. So take it, investors are expecting interest rates rises in the US, and hence they're buying the dollar.
Yeah.
But I had a interesting conversation with one of our US listeners this week, Herman, who and we were talking about the US dollar. Now, you're aware that the US is running an enormous current account deficit, actually a record current account deficit. And in order to balance the books, it therefore needs to run an enormous capital account surplus. Now, we know that foreign investors have largely stepped back from the US Treasury market. So what are they buying? What are those capital account inflows? Well, we strongly suspect that are flows into the US stock market, which is seeing enormous inflows as the Nasdaq and US technology stocks continue to outperform. But what happens when that trend inevitably reverses? I mean, Tesla and its ilk can't continue shooting for the moon forever. If the Nasdaq turns down, then you'd expect investors start selling down their equity holdings, and then what happens to the dollar? Because the capital account actually would turn negative, or would certainly
and the dollar
reduce.
they sell their investments, they repatriate into their own currency, and in the process, they sell the dollar.
Yeah.
So platinum didn't move very much at all on the week, and the rhodium seems to have stabilized after its meteoric rise and equally meteoric fall. And palladium doing the same as platinum. As we know, they're used in catalytic converters. The internal combustion engine production levels are reduced because the car production is reduced, so the demand for these metals is limited at the moment.
Okay, moving on to rates, and it was a volatile week. So the US, obviously, inflation came in hot, but then we had the fall in yields associated with the Fed interviewing Lael Brainard, the dovish Lael Brainard, as a possible replacement for Jerome Powell. And anyway, in the UK, we saw rates rise slightly on the week in the short end, but then fall on the long end. And I suspect that is associated with disappointing GDP numbers in the UK. And the market is expecting that inflation will be transient, and then we will drift down to disappointing GDP growth and low inflation. But what is interesting in the rates world is the periphery nations of the Eurozone. So this week, Greek yields ticked up further. And let's show you a chart. So back in August, Greek 10-year was yielding 0.5%, 0.55%. And it is now yielding the best part of 1.2 and rising in a straight line. And a reminder that the EU Pandemic Emergency Purchase Program, which allows them to buy essentially unlimited numbers of periphery nation bonds, runs out in March next year. And the market seems to be anticipating a spike in Greek bond yields when it stops. But this is the Italian, and it has not risen anywhere near as much. It's risen from 0.55% to 0.95%, so still a substantial rise. And obviously, Italy is a much bigger economy than Greece, and if there were to be a crisis in Italy, then there's not enough money to contain it, basically. But Spain seems to have left the pigs, and its yields are absolutely fine. Now, it was an extraordinary week because when the Fed interviewed Lael Brainard, there was a strong fall in yields, and real yields are very negative now. And what that shows, we discussed earlier, is the market it's pricing bonds as the sum of the short-term interest rates rather than looking at inflation. Is not concerned about real yields at all. And as a result, inflation break-evens continue to rise, although they're not extraordinary. This is the UK 10-year, ticked up a bit. US 10-year ticked up a bit. And this is the S&P seasonality chart. And we are entering a very strong period for the stock market. Strong run into the end of the year. So the seasonality chart is saying to remain fully invested. Richard, what do you get up to this week?
Thank you, Keith. Well, I had another quiet week, and regular viewers will know that my ambition is to have a quiet week. So I didn't buy anything, I didn't sell anything. My weekly change was up 0.3%. My change for the year, 11.4%. And that's against 14.6% for the FTSE All share. So my gold and silver mining shares started to pick up. They have had rather an unproductive few months, and they're starting to pick up now with the increase in precious metals prices. And that was offset by some falls in elsewhere in my portfolio. And I am quietly confident that the price of gold and silver will continue to go up from this point because inflation is really starting to bite and be understood by people that it's not transient. And therefore, I am hopeful that my portfolio will increase in value towards the year end. Famous last words, I have to say. And last week, I talked about the Cannabis ETF. And I said, if it breaks out of this trend, then watch it closely. And it is just peaking up above that top trend line. And that happened during this week. I'm not quite sure what triggered it. So I'm watching it closely. I haven't done anything, but I am keeping a close eye on it. And who knows, I may yet become a cannabis investor for the first time. Keith is looking suitably cynical. And that's because you have
I've got my own supply, Richard. I don't need to buy those.
Your large greenhouse. I wonder why you had such a big greenhouse, Keith.
Yeah.
So that's me for the week. Nothing terribly interesting to report, I'm afraid. How about you, Keith? How was your week?
Thank you, Richard. Well, I had an okay week, up 0.8%, puts me up 10.2% on the year, which is underperforming Richard and probably Stuart and underperforming the all share, but actually is a very decent return that I'm perfectly happy with, actually. Now, I did a bit of activity this week. I sold a little bit of Anglo Pacific, which I bought for yield and has been an indifferent investment. So I sold a portion because I wanted to buy some Antalya mining, which we will be doing a share talk on when we can find the time to record it. And I also sold some Parkmead. Now, Parkmead is a UK oil E&P. And when we were doing our share talk on Orcadian, which I hope you've all watched, I described Parkmead as possibly the least active oil and gas company in the UK, listed in the UK. And the more I thought about it, the more I thought that's true. And why on earth was I holding it? So I've done something about it. And what did I buy? Well, I bought some Atalaya mining. So got the pronunciation right this time, Atalaya mining. And we were doing a share talk on that. And I like it, actually. It's got a very good yield and shares look cheap. And it's a copper miner and we like copper. And I also bought some more Gulf Marine Services. Now, Gulf Marine Services are a highly indebted oil services company that rent out floating jackable rigs. And Paul Scott has been tipping the shares. And I came across the fact that he had been tipping the shares. And I already own a decent chunk, but I will be doing a share talk on it in the next couple of weeks. So watch this space. So this is Anglo Pacific Group, which share price has been indifferent since we covered it earlier in the year. This is Rambler, our problem child. And great news, since the financing, it seems to be recovering. And yours truly is still down, but I remain confident and I like the prospects of the company. And other investors are starting to buy in, which is all good news. This is Atalaya, and we're a bit late on this, frankly, but it's still, the shares are still cheap. And as we covered earlier in this week's weekly, momentum is good. And share price has momentum and it's got a yield of 7%. What's not to love? Yeah. This is Parkmead. I've made 30 odd % on it, but there are other better opportunities. Gulf Marine Services. Actually, I participated in the rights issue at 3p. So actually, I've done very well at 6p. Although obviously, if you held it since it was worth 50p, you're not looking so good. And that's it for the week. Thank you all for sticking with us and getting to the end. We had a lot to cover this week, and I hope you will press like and subscribe to the channel and come along to our drinks on Wednesday, the 1st of December, and think about donating to the cause. But in the meantime, it is goodbye from Richard Wheater.
And it is goodbye from Keith Jordan.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.